Could the AI bubble really be about to pop, and just how similar would it be to the dot-com era bubble? Because the entire internet has decided that they're basically the same thing. And I understand why, because the charts, well, they look almost identical. Take Cisco Systems that ran up several 100% into its March 2000 peak. Nvidia has done something even more extreme off its 2022 lows, but with the same parabolic shape, same breathless headlines, and same feeling in your gut that this can't possibly last. But here's the thing that nobody's actually checking. You see, the shape of these charts tell us nothing about what's actually underneath it. And when you look underneath the 1999 story and then the 2026 story, well, they couldn't be more different. Today I'm going to show you exactly why this is not 1999. At least not yet. And in this video, I'm going to show you the breakdown of what the dot-com bubble was actually built on, and then show you the cold hard numbers behind today's AI leaders. And finally, then give you the honest bear case for when this thing really does pop. Do me a favor, hit the like button, and let's get into today's video. Now guys, let's start by actually remembering what 1999 was, because the memory has gone a bit soft. The late 90s boom wasn't really built on revenue. It was built on eyeballs, clicks, and vague promises about future internet dominance. Companies were floating on the stock market with no profits, in many cases with barely any sales at all, and the market was paying up regardless. And the poster child for the infrastructure side of it was Cisco. At its March 2000 peak, Cisco was worth around $555 billion. For a brief moment, it was the most valuable company on the entire planet, bigger than even Microsoft. And the price you were paying for that? Well, depending on which sources you used, Cisco was trading somewhere between 200 times its earnings. 200 times. Think about that for a moment. You were paying 200 years of the company's current profits just to own a share. But the real rot wasn't even the equity in the debt. You see, the telecoms carrier was building out the physical networks, the WorldComs, the Global Crossings, the QS, and they collectively piled up close to $1 trillion in debt by laying fiber for demand that was quite frankly only existing on a PowerPoint presentation. WorldCom alone inflated its earnings by $11 billion and carried somewhere between $30 and $41 billion in debt before it collapsed from a $186 billion company to under $150 million. Global Crossings was literally booking capacity swaps, bartering network space with no cash changing hands as revenue. That was the foundation. Debt and dreams. So the question you should be asking yourself is simple. Does today's AI build out actually look anything like that? And this is where the safe haven of hindsight falls apart, because the honest answer is no. Not in the numbers that matter. You see, everyone's comparing these two charts is making one enormous assumption. They're assuming that the parabolic price means a hollow business underneath, and that was true in 1999 for the majority of cases. But in 2026, the price is going parabolic because the business is, not instead of it. And this is what I call the substance paradox, because the chart that looks the most like a bubble is actually the one that is backed by the most real, already existing cash flow in corporate history. Let me show you the numbers, because they're genuinely pretty crazy. Now, guys, let's actually look at what Nvidia is printing. You see, in 2026, Nvidia did roughly $215.9 billion in revenue. That's up 65% year on year from the $130.5 billion. And of that, around $193.74 billion came from the data center segment alone. That's nearly 90% of the entire company riding on the AI build-out. But revenue on its own means nothing if you're not actually keeping any of it. So here's the part that separates this completely from 1999. Nvidia's net income for the year was around $120.1 billion. That's a net margin of roughly 55%. So in plain English, for every dollar that is coming through the door, more than half of it drops straight into the bottom line as actual profit. The gross margin sits around 71% for a full year, and it pushed to 75% on the fourth quarter. Context, Nvidia's margins haven't always looked like this. They've historically been far more volatile, sometimes dipping well below current levels, which is exactly why the 71 to 75% range is so elevated. Now, remember Cisco at 200 times its earnings? Well, Nvidia, as of mid-July 2026, is trading at roughly 20 times its forward earnings. 25 times versus the 200. That is the whole argument in one single comparison, and here's a detail that most people have completely missed. Nvidia's stock is only up about 5% for 2026 so far. The all-time highs of 235.47 was all the way back in May and has been consolidating around the $200 mark ever since. So the stock has essentially gone sideways while the earnings have kept accelerating. That's the opposite of a bubble inflating. That's fundamentals catching up to the price. The story gets even more interesting when you look at Nvidia's customers. The customers buying all of this from Nvidia are the most profitable companies on earth. The big hyperscalers, the Amazons, the Microsofts, the Alphabets, the Metas, the Oracles, and they're all projected to spend somewhere between 660 and 750 billion on capex in 2026. And that's a jump of over 77% over 2025. And this is the single largest corporate investment program in human history. And crucially, unlike the telecom carrier of 1999, this is being funded overwhelmingly by the cash that these businesses are already generating. Microsoft's AI business is now running at around 37 billion in annualized rates, up 123% from last year. And AWS is running at around 142 billion annualized. Google Cloud grew 63% in a single quarter, with a backlog approaching $460 billion. These companies say they're demand constrained, not supply constrained. And Microsoft is reportedly sitting on an $80 billion Azure backlog it physically cannot fill, constrained entirely by the power grid rather than the chip supply. So let me chain the whole thing together for you. Real chips generate real revenue for Nvidia. That revenue converts to genuine sky-high profit margin. That profit gets spent as capex by hyperscalers. And that capex is backed by their own booming cash-generating cloud businesses, not by a mountain of junk-rated debt. The Nasdaq 100 is now on something like 11 consecutive quarters of 15% plus earnings. And JP Morgan is projecting that the Magnificent Seven will deliver around 20% of earnings growth in just 2026. That's the difference in one sentence. In 1999, the E in price to earnings ratio was basically fictional. In 2026, the E is still growing fast, enough to chase the P. So does that mean that it's all clear skies and that there is no risk here? Well, absolutely not. And I want to be honest with you, because pretending otherwise would make me no better than the hype merchants. Now guys, this is where I have to push back on my own argument, because there are some real cracks forming beneath the surface. You see, the real risks lie entirely in the timeline, as nobody serious is claiming that these products don't work. It's the gap between how fast the money is being spent and how fast it comes back. And here's the one thing from Sequoia Capital that captures this perfectly. Their analyst David Kahn identified roughly a $600 billion annual gap between what's being spent on AI infrastructure and what the AI ecosystem is actually selling. Think about that for a moment. $600 billion a year has to be filled by a future software revenue that hasn't really fully shown up yet. That's like me building a million different iPhones and then selling them to phone shops, but there's not actually any guarantee that those phone shops can then go and sell on those iPhones. Meaning that potentially somewhere in the future, someone will get left holding the bag. Now, I said earlier that this build out is funded by cash, not debt. I want to be fair here, because that's becoming less true day by day. You see, hyperscalers have raised around $108 billion in debt in 2025, with some projections pointing towards up to $1.5 trillion of debt over the next few years to fund all of the growth. So, the purely cash-funded narrative is true today, but the trend line is worth watching very closely, because potentially one day it won't be true. Because even if the profitable players are feeling the squeeze, some projections have Alphabet's free cash flow falling as much as 90% in 2026 to around $8 billion. While consensus analysts' estimates put the decline closer to 72% down, roughly $20.5 billion. Still a pretty dramatic drop from the $73.3 billion in 2025. And here's the mechanism that actually ends this cycle. And it's got nothing to do with the 1999 style bankruptcy. When growth slows from 90% year on year down to around 20%, the multiple the market pays collapses violently, even for a genuinely great company. Now this is the part where history gets really uncomfortable, and it's the other side of the story that the bulls are conveniently ignoring. Because being a real business does not protect you from being a terrible investment. And the single best example of that is the very company we started with. Cisco was never a fraud. Its revenue actually kept growing after the crash, nearly tripling from around 19 billion to 52 billion over the following 2 decades. The business was completely fine. Well, the stock fell 88% over 2 years, and then it took over 25 years for it to reclaim its March 2000 high, finally getting there in December of 2025. And that 25-year recovery period is the exact risk that we face today. You see, if you bought the best infrastructure company of the internet era at the top, and then you waited for a quarter of a century just to break even, the company succeeded, but the exorbitant purchase price destroyed your returns. And this maps almost perfectly onto today, but with one enormous distinction. Back then, there was a mechanism called vendor financing, where Cisco and Lucent literally lent money to cash-strapped startups so that those startups could turn around and buy Cisco and Lucent's equipment. A circular loop of manufactured demand. And analysts right now are flagging a modern version of exactly this, where chip makers and cloud providers invest in the very AI startups that then buy their compute power. That's the one.com parallel that genuinely does rhyme, and it's the specific thing to keep your eye on. So, how do you actually position for this without getting burned? Well, let me give you the levels and the signals that matter. First, watch the capex to revenue ratios. Oracle is now spending 86% of its revenue on capex, Meta 54%, Microsoft 47%. When those numbers stop rising and start to plateau, that's your first warning that the spending cycle is topping. Second, watch the 10-year treasury yields. Analysts warn that if there's a break above 4.5%, it could trigger a systematic de-risking of growth stock valuations across the board. Rich multiples and rising yields do not coexist for very long. Third, and this is probably the biggest one, watch for the software monetization. If the enterprise revenue keeps lagging behind the hardware spend, that $600 billion gap doesn't close, and eventually the hyperscalers demand a return that the software companies simply cannot deliver. And finally, as with every investment, understand the concentration of risk that you are personally carrying. The Nasdaq 100 is now so top-heavy that a single earnings miss from Nvidia or Microsoft can swing the entire index 2 to 3% within hours. Now look, I'm not here to tell you what you should do with your money, so do your own research and make your own decisions, because you can't borrow someone else's conviction. But the biggest mistake you could make right now is buying the 1999 comparison wholesale and either panic selling great business, or the flip side, assuming that great business can't hand you a 25 years of dead money. Both of those errors come from just watching the charts instead of the cash flow. So, let's bring it all home. Are we really in 1999 again? Well, the data says absolutely not. The dot-com bubble was a solvency crisis, built on nearly $1 trillion of telecom debt and companies with fictional earnings. The AI build-out is being funded, for now, by the most profitable companies in human history, with Nvidia printing $120 billion at a 55% margin and trading at 25 times earnings, not 200. But the music will eventually stop. Instead of ending in WorldCom-style bankruptcies, the cycle will break the moment that the hyperscalers demand an ROI on the $600 billion annual revenue gap that the software can't immediately provide, cooling the growth rate from 90 to around 20%. But until that cash flow dries up, the underlying engine is still very much running. Once you realize that purchase price drives bubbles more than the asset quality, you can ignore the scary chart comparisons and focus on the numbers that actually matter. So let me know down below in the comments, do you think hyperscalers are wildly overspending, or does this capex cycle still have years left to run? Do me a favor, if you haven't already, hit the like button, make sure you subscribe to the channel, and share this channel with any of your friends or family who are thinking about getting into tech stocks so that they can understand for themselves there is a lot more out there than just staring at charts and hoping for the best. Guys, I hope you enjoyed today's video. See you on the next one. Bye bye.